The stock for us that was worth a much closer look at post-reporting season was Freedom Foods, and that was following a very strong result. We upgraded the stock to a buy recommendation and $5.16 price target. It's now, in fact, our preferred stock pick across food and beverage, and that's because it's a business that has both defensive qualities but also very strong growth characteristics, and it's also trading on an undemanding forward PE, particularly versus its food and bev peers. I just thought we'd quickly just recap on what the business does. So Freedom Foods is a very large food, beverage and dairy company. Essentially, it's selling products that are healthy for you. So that's a great place to be because it's in line with consumer trends. So therefore, it's operating in food categories that are defendable and have growth characteristics. If we look at its product portfolio, it does own a number of household brands, whether across cereals and snacks, that's the Freedom Foods, Heritage Mill and Arnold Farms brands. If you have kids, I'm sure you know the Messy Monkey brand for children's snacks. It owns Australian own in UHT milk, and then it also has the Milk Lab products and Almond Breeze products in plant-based or almond milk. So it's actually the category leader in the almond milk category, which is growing at strong double digits. It also has a small seafood business. And then in recent years, it's been expanding into nutritional products, whether that's been infant formula or its sports nutritional brands, such as Vital Strength and Crank. The company does own most of its assets, and it has a number of manufacturing assets across New South Wales and Victoria. And in fact, over the last 6 years, up until this FY20 year, it has spent close to $700 million on CapEx, whether it's building state-of-the-art dairy facilities, plant-based facilities, or nutritional capability. It very much has a vertical integration strategy. Why? Because that allows you to capture more of the margin along the chain, but it also allows you to be in control of your own destiny in terms of product innovation. And if I use that vertical integration strategy for a moment, it's dairy vertical as an example. So it owns a stake in Australia's largest and most efficient dairy herd. It then owns one of Australia's largest processing assets, where it's processing UHT dairy milks that go throughout Australia and Southeast Asia, and high margin, high value nutritional dairy ingredients. It's then putting it into retail friendly products such as below. If we look at where it sells, it's selling throughout Australia, China and Southeast Asia. It does have a nice diversified channel to market strategy, and it's particularly focused at the moment on that out-of-home market. Why? Because it's double the margins of the supermarket, and the out-of-home category is very much like your old route trade, whether that's your petrol stations, your convenience stores, your coffee shops, etc. And the other big focus is obviously Asia, given your products sell for a higher price point. The company does have a very strong earnings growth trajectory over coming years, as you can see from that graph, and that's all about its leverage to healthy eating trends. So they're operating in a growth category, as we discussed. It has a number of growth products coming through and a very strong product innovation pipeline. It's growing in those higher margin markets, such as out of home and Asia. The big one, though, is the scaling of its facilities. So at the moment, its new state-of-the-art dairy plant-based facilities are probably operating at about 50% capacity. Over the next 3 to 4 years, as they ramp up to 100% capacity, there will be significant margin expansion because, as you'd be aware, manufacturing is a high fixed cost game. So the more volume you add, the more your margins expand. And then lastly, it's been expanding in some very high margin nutritional ingredients products such as lactoferrin, which sell for a very high price point. Just in terms of the earnings split, when you invest in Freedom Foods, really you're investing in a very large dairy and nutritionals business, and also you're getting exposure to plant-based diets, in particular in the beverage form. So we've upgraded the stock to a buy after having sort of a neutral negative view for a number of years, and I suppose the key reasons why is that the first half result was strong. It did have some very encouraging signs that strong earnings growth can be delivered as these plants start ramping up. Its Milk Lab brand, as you can see on that slide, is literally booming. It's in 10,000 outlets around the country and Asia at the moment. Over the next 2 years, it will be in 30,000 outlets. It's about to go into McDonald's and a number of other QSRs. The share price leading into that result has been weak. But look, based on our FY20 forecast, the stock's trading on the cheapest forward multiple it ever has. This stock has never been cheap, but it's currently on a FY21 PE of a little over 19 times. Now, when I compare that to my sort of, global food and bev comps, they're trading on sort of 20, 25 times. They're lucky if they offer sub sort of 5% growth. This is a business that's going to deliver very strong double-digit growth over at least the next 3 years. And then the last point I think is particularly important at the moment. In a volatile market, it's a great defensive business. We still need to eat. And just to conclude on the risk, I suppose it's the most topical at the moment, being the coronavirus. Clearly, if that impacted sales more than budgeted, that would be downside. But management has factored in some short-term demand and supply chain disruptions. I would note, while China is a big part of its growth strategy, it's about 15% of its sales at this point. So look, that's Freedom Foods. Buy recommendation, $5.16 price target. Please have a closer look at it.